Why investing instead of saving in a savings account can change your financial future. What if I told you that someone who put $10,000 into a savings account 10 years ago actually has less purchasing power today than when they started, even though the number on their screen is higher? That's not a theory. That's not clickbait. That is basic math. And it's happening to tens of millions of Americans right now, every single day, without them even realizing it. But here's what I want you to understand before we go any further. This video is not here to scare you. It's not here to make you feel like you've been doing everything wrong. Because the truth is, nobody really teaches this stuff. Not in high school. Not in most colleges. And definitely not by the bank that's been happily collecting your deposits for years. What I'm here to do today is show you a different path. A path that regular people without finance degrees, without trust funds, without six-figure salaries, are using right now to completely transform their financial futures. And the best part? You can start today, regardless of how much you have, regardless of where you are right now. So if you have a savings account, don't go anywhere. What you're about to learn might be one of the most important financial lessons of your life. Here's exactly what we're going to cover in this video. First, we're going to break down why the traditional savings account is quietly working against your financial future, and the numbers behind it are going to surprise you. Second, we're going to look at the real alternatives that are available to everyday Americans right now, options that are safe, accessible, and that you can open from your phone in under 10 minutes. Third, I'm going to walk you through a simulation, real numbers, real math, that will show you exactly what the difference looks like over 10, 20, and 30 years depending on where you put your money. And fourth, we're going to talk about how to actually get started, step by step, even if you've never invested a single dollar in your life. Stay until the end, because that simulation I mentioned, the one with real numbers, is going to be the moment everything clicks. Let's get into it. The problem with savings accounts. Why your savings account isn't actually saving you. Let's start with some context. The traditional savings account has been around in the United States for well over 100 years. It was built for a different era, a time when there were no index funds, no online brokerages, no apps that let you buy a fraction of a stock for $5. Back then, the savings account was genuinely one of the only accessible options for everyday people. But that era is long gone. And the savings account, for the most part, hasn't kept up. Here's the core problem. As of recent years, the national average interest rate on a savings account in the United States has hovered around 0.45% to 0.60% per year. Now, some high-yield savings accounts, offered mostly by online banks, can get you closer to 4% or 5% when the federal funds rate is high. But the vast majority of Americans are still parking their money in traditional savings accounts at big banks, earning a fraction of a percent. Meanwhile, inflation in the United States has averaged between 3% and 4% per year over the long run. And in recent years, it spiked much higher than that, hitting above 8% in 2022, the highest level in 40 years. So let's do the math together. If your savings account pays you 0.5% per year, and inflation is running at 3.5% per year, your real rate of return, what economists call the inflation-adjusted return, is -3%. Negative. That means every single year your money sits in that account, it is buying you less and less in the real world. Your balance might go from $10,000 to $10,050 after a year. But that $10,050 can buy you less than what $10,000 could buy you 12 months earlier. You're moving forward on paper and falling behind in reality. And there's another layer to this that almost nobody talks about. When interest rates are high, like they've been recently, some savings accounts do start to look more competitive. A 4.5% or 5% yield sounds pretty good, right? But here's the thing, those rates are not permanent. They go up and down with the federal funds rate set by the Federal Reserve. When the Fed cuts rates, those yields drop. And historically, over long periods of time, savings accounts have never consistently beaten inflation over decades. The stock market, on the other hand, has returned an average of around 10% per year over the last 100 years, before inflation. After inflation, that's still around 7% annually, year after year after year. That gap, between 0.5% and 7%, is where financial futures are either built or destroyed. The real alternatives. Where should you actually put your money? Good news. In the United States, you have access to some of the best investment tools in the entire world. Tools that are free to use, easy to understand, and available to literally anyone with a social security number and a smartphone. Let's walk through them. 1. High-yield savings accounts, the first step up. Before we even get to investing, let's address something basic. If you're in a traditional savings account earning 0.3% or 0.5%, the single easiest move you can make right now is switching to a high-yield savings account. Online banks like Marcus by Goldman Sachs, Ally Bank, and Marcus have offered rates of 4% to 5% in recent high-rate environments. This isn't investing, it's just smarter parking for your emergency fund. Your money stays fully liquid, it's FDIC insured up to $250,000, and you earn significantly more while you figure out your next steps. This alone won't build wealth. But it's a great starting point, and there is absolutely no reason to be in a traditional savings account when this option exists. 2. Treasury securities, backed by the U.S. government. Treasury securities, T-bills, T-notes, and T-bonds are debt instruments issued by the United States federal government. When you buy a treasury, you are essentially lending money to the U.S. government, and they pay you back with interest. These are considered the safest investments in the world. The U.S. government has never defaulted on its debt obligations in its entire history. Treasury bills, which mature in less than a year, have recently offered yields in the 4% to 5% range. Treasury notes and bonds go out further in time and offer slightly different rates depending on the interest rate environment. You can buy them directly through treasurydirect.gov with no fees, starting at just $100. For anyone who wants the absolute maximum safety with above savings account returns, treasuries are the gold standard. 3. CDs, certificates of deposit. A certificate of deposit, or CD, is an account you open at a bank where you agree to leave your money for a fixed period of time, 3 months, 6 months, 1 year, 5 years, in exchange for a guaranteed interest rate. CDs are FDIC insured up to $250,000 per bank, per ownership category. The rates are typically higher than regular savings accounts, especially for longer terms. And because the rate is locked in, you know exactly what you're going to earn when the CD matures. The trade-off is liquidity. You can't pull the money out early without paying a penalty. So CDs work best for money you know you won't need for a specific period of time. 4. Index funds and ETFs, the long game. This is where real wealth building begins for most Americans. An index fund is a type of investment fund that tracks a market index, the most common being the S&P 500, which represents 500 of the largest publicly traded companies in the United States. When you invest in an S&P 500 index fund, you're buying a tiny piece of 500 companies at once: Apple, Microsoft, Amazon, Google, Berkshire Hathaway, and hundreds more. The historical average annual return of the S&P 500 is approximately 10% per year, including dividends, going back to the 1920s. ETFs, exchange-traded funds, work similarly to index funds but are bought and sold on the stock exchange like individual stocks. They often come with very low fees, sometimes as little as 0.03% per year. Some of the most popular options include Vanguard's VOO, which tracks the S&P 500, iShares IVV, and SPDR's SPY. You can buy these through any major brokerage account. The key with index funds and ETFs is time. The longer you stay invested, the more the power of compound interest works in your favor. This is not a get-rich-quick strategy. This is a get-wealthy-over-time strategy, and it works. 5. Retirement accounts, 401k and IRA. This deserves its own conversation, but I have to mention it here because it's one of the most powerful tools Americans have access to and one of the most underused. A 401k is a retirement account offered through your employer. In 2024, you can contribute up to $23,000 per year. Many employers offer a match, meaning if you contribute 3% of your salary, your employer also throws in 3%. That is free money. A 100% return on your contribution before any market gains. An IRA, individual retirement account, is something you open on your own, independent of your employer. In 2024, you can contribute up to $7,000 per year to a traditional or Roth IRA. The Roth IRA is particularly powerful for younger people. You contribute after-tax dollars, and all the growth, every dollar of gains, every dividend, every bit of compound interest, comes out completely tax-free in retirement. Think about that. You invest money today. It grows for 30 or 40 years. And when you take it out, you owe the government nothing. Every dollar you invest in a savings account instead of a Roth IRA is a missed opportunity that compounds, literally, for decades. The simulation that changes everything. Now here's the moment I promised you. The real numbers. Let's look at 3 different people. All 3 are 30 years old. All 3 have $500 per month to put aside. All 3 are disciplined. They never miss a month. The only difference is where they put their money. We're going to run this out over 30 years, until they're 60. Person A, traditional savings account, average annual return, 0.5% total contributed over 30 years, $180,000 final balance at age 60, approximately $185,000. They barely beat their own contributions. After inflation, they almost certainly lost purchasing power. Person B, high-yield savings account / CDs / treasuries, average annual return, 4.5% total contributed over 30 years, $180,000 final balance at age 60, approximately $376,000. More than double. Person, same money, same discipline, just a better place to put it. Person C, diversified portfolio, index funds, ETFs, Roth IRA, average annual return, 9%, conservative long-term estimate for diversified portfolio, total contributed over 30 years, $180,000 final balance at age 60, approximately $908,000. $908,000 versus $185,000. That is a difference of over $720,000 from the same person, putting aside the same $500 a month over the same 30 years. The only variable was where the money went. That is the power of compound interest. Albert Einstein reportedly called it the 8th wonder of the world. And a standard savings account throws that wonder completely in the trash. Now let's push this even further. What if person C starts at 25 instead of 30? 5 more years of compounding? At 9% annual return with $500 per month starting at age 25 and running to age 60 to 35 years total, the final balance climbs to approximately $1,430,000. $1.4 million. From $500 a month. That is what starting earlier does. That is what compound interest does when you give it time and the right vehicle. And that is exactly what a traditional savings account robs from you. Silently, slowly, month after month, while you think you're being responsible. How to actually get started? Okay, I get it, but how do I actually start? This all sounds complicated. It's not. I promise. Here is a clear, simple path that anyone can follow. Step 1. Build your emergency fund first. Before you invest a single dollar in the market, you need an emergency fund. This is non-negotiable. An emergency fund is 3 to 6 months of your essential living expenses, rent, food, utilities, transportation, sitting somewhere liquid and accessible. This is your financial shock absorber. Job loss, medical bills, car repairs. Life happens, and without this cushion, you'll be forced to sell investments at the worst possible times. Put this in a high-yield savings account. Not the stock market. Not a CD with a penalty. Somewhere you can access it in 24 to 48 hours without any consequences. Once that's in place, you're ready to invest. Step 2. Open a brokerage or retirement account. If your employer offers a 401k with a match, start there. Contribute at least enough to get the full employer match. That is the guaranteed return that no other investment can compete with. After that, open a Roth IRA. You can do this with Fidelity, Vanguard, Schwab, or any major brokerage. All for free, all online, in less than 15 minutes. You'll need your social security number, a bank account to link, and a government-issued ID. If you want a general brokerage account for money beyond your retirement contributions, those are just as easy to open at the same institutions. Step 3. Define your time horizon. Your time horizon, how long until you need the money, determines what you should invest in. Money you'll need within 1 to 2 years belongs in high-yield savings accounts, CDs, or short-term treasuries. Keep it safe and liquid. Money you won't need for 3 to 7 years can go into a more diversified mix of bonds and conservative funds. Money you won't touch for 10 years or more, especially retirement money, belongs in growth-oriented investments like S&P 500 index funds and ETFs. This is where you want maximum exposure to long-term market returns because time is your greatest asset. Step 4. Start automatically and stay consistent. Set up automatic transfers. Every payday, before you spend a single dollar on anything else, have a predetermined amount move automatically into your investment accounts. This is called paying yourself first, and it is the single most effective habit of every person who has successfully built wealth over time. You don't wait to see what's left at the end of the month. You decide upfront what you're keeping for your future, and then you live on the rest. Start with whatever you can. Even $50 a month is better than nothing. Even $25. The amount matters far less than the habit. Once investing becomes automatic, you can increase the amount over time as your income grows. Step 5. Keep it simple and ignore the noise. The financial media loves drama. Market crash headlines. Bear market panic. Predictions about what the economy will do next. Ignore it. If you are investing in diversified index funds with a long time horizon, market dips are not disasters, they are sales. When the market goes down, your automatic contributions are buying more shares at lower prices. That's a feature, not a bug. The people who lose money in the market are almost always the ones who panic sell during downturns and miss the recovery. The people who build wealth are the ones who stay the course, contribute consistently, and let time do the heavy lifting. Warren Buffett, arguably the most successful investor of the 20th century, has repeatedly said that for most ordinary people, the best investment is a low-cost S&P 500 index fund held for decades. Not complex strategies. Not timing the market. Just consistent, long-term investing in the whole market. The mindset shift. I want to talk about something that goes beyond the numbers for a minute. Because here's what I've noticed. When people start investing, when they actually move money into an account and watch it grow in real time, something changes in them. Something beyond the financial. They start thinking differently about time. About their decisions. About the relationship between what they do today and who they become years from now. A savings account keeps you in survival mode. You're protecting what you have. You're guarding against losing. That's an important instinct, but it's not enough to build a life. Investing puts you in growth mode. You're making a bet on the future. You're saying, I believe the world will keep moving forward. I believe in the value of human productivity and innovation. And I want to participate in that. That shift, from protection to participation, changes how you see money entirely. You stop treating every dollar as something to guard and start treating every dollar as something that can work for you while you sleep, while you eat, while you spend time with the people you love. That is what financial freedom actually feels like. Not a specific number in an account, but the knowledge that your money is moving in the right direction, day after day, whether you're watching it or not. The savings account tells you to stand still. Investing tells you to move forward. And the sooner you start moving, the further you go. Closing and call to action. Let's bring it all together. Today we covered why the traditional savings account is silently eroding your purchasing power year after year, and why the gap between saving and investing is measured not in percentage points, but in life-changing sums of money. We looked at the real tools available to you right now: high-yield savings accounts, treasury securities, CDs, index funds, ETFs, 401(k)s, and Roth IRAs, all accessible to any American with any income level, starting today. We ran the simulation. We saw the $720,000 difference. We saw what starting 5 years earlier can do. The math is clear and it doesn't lie. And we walked through exactly how to get started, step by step, no fluff, no complexity. Here is your one takeaway from this entire video. The best time to start was 10 years ago. The second best time is right now. Not next month. Not when you get a raise. Not when the market feels safer. Right now. If this video helped you see something you hadn't seen before, hit the like button. It genuinely helps this content reach more people who need it. And if you know someone who is still keeping all their money in a traditional savings account, a family member, a friend, a coworker, share this video with them. It might be one of the most valuable things you ever do for someone you care about. Subscribe to the channel if you want to keep learning about money in a way that's straightforward, honest, and built for real people. I'll see you in the next one. Take care of your money, because when you do it right, your money will take care of you.